Hi, everybody. Thanks for joining. We'll start in another 1 minute. Hi, good afternoon, everybody. My name is Ashima Segal from DFAN. I would like to welcome you all to this webinar on how not to fundraise, hosted by Digital Futurist Angels Network and Mighty Startup Hub. So today's session is part of a joint initiative between DFAN and Mighty Startup Hub. The partnership was established with the view of jointly adding value to the Indian startup ecosystem and creating a community of problem solvers. Most of you would be familiar with DFAN and Mighty. For those of you who are not, let me briefly cover about our working framework. So our organization, DFAN, is headquartered in Gurgaon and is a pan-continent early-stage angel investment platform formed with the vision to help, nurture, and grow startups. DFAN's thesis of investment is to invest into sector-agnostic, deep tech, tech-enabled B2B and B2B2C startups. We provide funds at early stage to startups which are preferably built their MVP and have some early traction. Our typical investment ticket size ranges between USD 50K to 150K. And over the last 18 months of existence, we have evaluated more than 500 startups, have invested in 6 with a couple of more in pipeline. Our partner, Mighty Startup Hub, is an institution set up with a mission to build conducive innovation and startup ecosystem by bringing together various technology innovation stakeholders and paving the way towards a strong economy. So happy to launch our second session of the webinar series, Fridays with Founders. Today's speaker is Utkarsh Roy. He will be covering around various nuances of fundraising. Utkarsh is a co-founder of Introbot, a WhatsApp bot which lets you network and find intros to people in the startup ecosystem. Along with being an alum of TechStars, Utkarsh is a computer science graduate from the University of Toronto and has also been a Stanford Graduate School of Business's Ignite Fellow. With this, over to you, Utkarsh, requesting all the attendees to go on mute unless they're speaking. We'll be taking the questions at the end of the session. You may use a chatbot to ask the questions or directly address them to Utkarsh by unmuting yourself. Thank you.
Thanks, Ashima. Great to be here. Thanks, Harry, for making me part of the DFAN and MSH panel. So glad to see so many people, many familiar faces, and I hope this is useful to some of the pre-seed founders and entrepreneurs who are raising capital right now. I mean, this is my third startup, and I have failed a number of times at many projects. I have probably talked to 150 plus investors over the last 3 years, and it's been quite a journey. I mean, in Introbot, it was pretty easy to raise funds, but previous to that, I have had my fair shares of ups and downs. So the idea is that I can just share some of that knowledge with the folks here, in the hope that many of the newer entrepreneurs do not have to face such issues. And while I was thinking of a topic, I just thought that, hey, I mean, just let's make it more funny and humorous and have some fun. So I've kept it a little interactive, and I've tried to add a few stories along the way that I found through my own journey and also through the startups that I've mentored. So with that, let me pull up my slide deck to share with you all. Ashima, Harry, anything else, or like it going?
Yeah, you can go ahead. No problem.
Can you all see my screen?
Yes, it's Utkarsh visible.
Yeah, so this talk is about how not to fundraise. And let me tell you what we're going to cover here. So I won't drag the talk too long. I will just focus on 5 different topics. And we just are going to go one topic and discuss about that and then move on. So typically through this journey of these topics, I would be able to touch the different aspects of fundraising, straight from the ideation to what do you do after you raise funding. And this is more about what you shouldn't be doing versus what you should be doing. So with that, let me go ahead. The first one, don't swing the engineering hammer. So do you all know who this is? Obviously, this is Thor, but this is also a typical engineering graduate from the Indian ecosystem. So all of us have been really trained to go ahead and start solutioning the moment we have an idea. And that's what most of my startups that I've mentored do. They just think of something, jump into it, start coding, work on the alpha, beta, MVP, and then launch. They don't really spend enough time worrying about the market or the need or what people are actually thinking about in terms of what they require in the space. So what you should do instead is focus on the need. So, and by need, I mean the bottoms up need, not the top-down market expansion-based thesis that, hey, this is going to work. So I have had one startup which approached me for mentorship a while ago, and they were building tools for remote work. And they told me, hey, remote work is growing 50% year on year, and with COVID is going to expand. That is the reason we are building a Zoom competitor. I'm like, that's fine, but has anybody actually told you that they are looking for a Zoom competitor? What is the basis for the other mission that you're going and jumping straight away into the solutioning and writing code on this? So what I've seen people do is they jump from the idea to the product without really stopping in between. What I do propose here is that instead of doing that, what you should do is you break down the idea into different theses. For example, the thesis could be people are using multiple different apps like Calendly, Zoom, Google Calendar, and so on to shuffle across their meetings. So is there a pain point or not? So that should be the fundamental thesis. And what you do is you go ahead and talk to multiple users and different sets of user personas. Either validate the thesis or invalidated the thesis. Once you understand that, hey, I mean, we are actually moving the needle in terms of the success metric, only then you start working on the product. And I've been part of Entrepreneur First. It's a leading accelerator. And what I learned from there is that they really focus on understanding the problem from the grassroots level. And that has really helped me. And I think this will help other founders who are starting out as well. Also, one more thing is focus on pattern matching. So I have lots of founders and startups telling me that, hey, I've talked to 10 people and I realized that this is a problem. Fine, I mean, that could be a problem, but then how do you know that the problem is big enough to be solved? And for that, I use this model called the Porthole Model. This basically what that means is that we are trying to understand as founders how big the pothole is for users. So what I do is I have this relative indexing of 0 to 10, where I literally go and ask the user, I mean, if this is the problem, how big is the pothole for you? And you rank it basically. So there are multiple problems, and then we rank based on the size of the pothole for the particular problem. And along with that, what we also do is we talk to multiple sets of these user groups and then collect those metrics. So we understand like, hey, like this big is the first use case that we need to go after. And what you need to understand is that idea is typically broken down into multiple use cases. Unless you're focusing on a single use case to start with, and you're trying to build everything for everybody, that's a failure. That's a recipe for failure. So don't do that. I'll jump to the next topic, where I will share a few experiences on what happens when founders try to pitch the very first time. If you have any more questions on that, we can take it offline or after the session. So this is what happens for first-time founders. They have a certain idea and they go and try to sell that to investors. And I had one founder who came to me and he told me like, hey, I'm building a super app. And I asked him, okay, so what does your super app do? And they're like, so we can order milk through this, grocery through this app. We can get cabs, we can get medicines, everything else. It's super efficient. Everything is on the same platform. And I'm like, yeah, but you have those services on different apps. Why would you want to do it? And anyway, if you are successful, how are you going to execute at that scale? And they're like, yeah, but the efficiency of those apps, and I have to switch between different apps, it's just not efficient for me. So what he was trying to do is build all those tens of features onto that single product of his without understanding the concept of product market fit. And typically product market fit happens when you remove features from the product, not really add to it. And a fallacy that startup founders typically face is that, hey, the product is not working. Let me add one more feature to it and it will start working. And they go ahead and spend 3 months and building that feature. And they keep on doing that. And ultimately the product or the platform becomes this massive chunk of feature base that doesn't really work or solve any problem for anybody else. So instead, what you should do is not to build a flying car. And especially when you're talking to investors, you should not try to sell that flying car. What you should try to sell instead is your understanding of the market knowledge and the gap that exists. So you need to understand that investors don't really care about how innovative your product is. What they really care about is whether your customers understand and appreciate the innovation that you have built in. And I've seen a lot of founders really try to pitch their product. And I did the same. So I used to spend my time really talking about, hey, what I've built is amazing. This is like the next unicorn out there. And now I've started realizing, I mean, nobody cares about the product. They really care about, does this solve a problem for somebody or not? And how specific the product can become. And with that, you need to really show the traction that you've achieved. And let me highlight what traction means, because I've realized that a lot of founders, including myself, understand the word traction in different ways. They typically think that traction is what they've done over a period of time. Like somebody told me, hey, I have huge traction. I'm like, hey, what did you do? And they're like, I have built a team of 15 people. I'm like, yeah, but that's not traction. Somebody tells me I have 100,000 users on my platform. That's not traction. What traction means is basically a proof that your thesis is actually working. That's what traction is. You need to prove to investors that either you have understood the demand in a certain way and you're going the right direction, or you need to tell that the solution is working. So in terms of investors and stages, typically there are multiple investors coming on board at different stages. And this talk is designed for pre-seed founders and seed founders, and typically would interact with angels, angel networks, angel groups, syndicates, micro VC firms. Some larger funds like Sequoia and Axel have also come into the pre-seed stage now with the new programs. But you need to understand that what they're looking for is not a solution traction. They're looking for a demand traction. And what that means is you need to show a way and a number that proves that your idea will work when implemented. And that's the reason you're raising funds for. I've seen a lot of founders try to build the MVP and then use Google ads and Facebook ads to get tons of users. And then they typically go to investors and say, hey, we have like 50,000 users on a platform and we should get funded. And Sequoia is like, no, you shouldn't. And they're right, because numbers, the wrong numbers do not prove anything. You need to get the right numbers which prove your thesis. So you need to build the thesis first, have the set of KPIs, and then work towards proving or disproving that. And while you do all these things, you need to make sure that not only you're business ready, but you're also investor ready. And these two are two different things. Your business could be working out really well, but unless you're investment ready with the right angling of the problem definition, you have the right way to show the numbers. You have a proper deck setup. You have a company that could typically raise funds. And for US-based startups, that's like a C Corp. For India, it's private limited. So unless you have those basic legalities set up and you have the right set of deck and content, you shouldn't start the fundraising process for your company. I have seen a lot of founders, they have this idea and they start talking to investors. Well, that's not the right way to go, my friends. And lastly, you should be building up investor pipeline sheet. That is like the fundamental operating system of how you manage and run your investment process. And we'll talk about that a bit later on. But without the pipeline and the Excel sheet, you really don't know how many investors you're talking to, how many threads you're running parallelly, and so on. And it becomes a mess. And I have templates for this, so happy to share with people who ping me after the talk, how to build a investor pipeline. So moving ahead, so this is the third out of the fifth topic. So we are already halfway through. And I will address all the questions and comments at the end, because it's a bit distracting to see the chats while speaking. So now you have your business ready. You've understood the need. You've understood what your users want. You have the right set of perspectives that you need to go after when fundraising. What you do is contact these investors. Now, if you remember, this is a scene from the show Silicon Valley. And I know many of you must be fans of Silicon Valley. And I have seen this show like 3 times. And in this scene, you can see that Richard, who is the founder and CEO of Pied Piper, the startup that they're trying to build, tries to stand outside a hotel, a posh hotel in the Bay Area. And they're trying to talk to Peter, who is a billionaire investor. And he literally doesn't listen to them for more than 10 seconds. He just waits for his car and goes away. And he got the meeting, but typically that's not the way you should be targeting investors. There's a proper channel. There's a way you should approach. There's a set of lines you should be saying to get your first meeting. And there's a way you progress through the meetings. And if you realize through your journeys and through what I've been speaking so far, this is an art. Fundraising is more of an art than science. And that is why you see these huge companies like raising huge rounds of funding, because they've learned the art of fundraising. It's like preparing for the job interview versus doing the actual job. Those two are slightly different things. And you need to get better, good at both. So the best way to get to any investor is through warm intros. I will tell you a brief statistics of the Indian and the US market. So most of the top funds receive almost 3,000 to 3,500 pitch decks or pitches in some form throughout the year. Only 10% of those pitches actually get invited to the first meeting. And over the course of a year or so, most of the larger funds typically invest in less than 50 companies. What that means is that they are meeting so many people, typically anywhere between 3 to 10 startups in a day, that they cannot see your deck. They cannot go through your entire deck and your story. They cannot take your meetings. And that's fundamentally not possible because, I mean, let's be honest, not every investor is Tiger Global, and they just don't have the army. So what they rely on is the network. So you must have heard this phrase, right? It's not what you know, but who you know that matters. And that's where warm intros come into the picture, because there's a fundamental trust displacement that's happening from one person when he or she recommends you to somebody else, say to a partner at a VC firm. And that's when they take meetings. And fundamentally, what you need to do is also start doing and building these relationships early on. So networking is like insurance. When you really need a connect, you won't have it. I mean, it is too rude to ask for somebody to introduce you to someone. But if you have already met that person and you have forged a relationship, and then you go ahead and ask, like, hey, can you introduce me to Axel or Sequoia or somebody else? Then it's super easy to get that intro. So you need to invest time in building these relationships. You need to think like 6 months to 1 year ahead, and write out your entire network graph and figure out who you need to meet in the next 6 months who could help you potentially in your fundraise journey. So in fact, what I did when I was in Silicon Valley was I had this massive OneNote page where I mapped out all the investors and interlinkages between these investors as well, because investors work in clusters. And all of these clusters are trying to find hidden gems before the other cluster does. So you need to understand how investors and generally the VC ecosystem is connected to each other. And typically all of these people know each other. So make sure you're being consistent with different groups, not falsifying any data and so on. And there are certain channels that can help you. So let me talk about Introbot. This is what I'm building right now. It actually helps you get warm intros with high efficiency and high trust. And the reason why me and Divyansh, my co-founder, are building this is because we face the same problem. How do we meet investors? Do we give out like 7 to 10% equity to larger accelerators, or there's a better way to do it? And with that idea, Introbot was born, and we kind of deployed it in Founder Circle, which is another community I run, comprised of 1,500 plus founders. And we realized that, hey, a lot of people really want to meet other people. People want to fundamentally take help from other founders, potential advisors, mentors, investors, and so on. And that's the reason we built Introbot. Introbot is like a sweet and simple WhatsApp bot. I'll share the link after the talk, and you can click on it and you can just enter keywords there. Like, hey, I want to meet investors in pre-seed stage for SaaS business. And you would start getting recommended from the 150 or so investors we have in the pool. So I find that's the easiest way, and obviously I'm biased, but then there are other ways to meet folks as well. So Angel List has worked out pretty well, although the list is a little old, and you can give it a shot. There is another tool called startups.com. I have not mentioned it here, but that's a pretty good tool as well. And you actually get email IDs of investors from the tool. There are other ways to build out email lists and so on. So personally, I have multiple lists of hundreds of investors across India and US that I've been using. That includes angels, syndicates, different funds, and so on. So I have collected through my last 3 to 4 year journey, and I'm connected to a lot of these startup ecosystems and communities. So that's how I also, get a lot of these interesting information. So happy to share some of them with the audience here. Please do connect with me after the talk. Fine. So now you got the meeting, and somebody has told you, hey, can you share a blurb? so that I can forward it to a partner in the fund or to an associate in the fund. And what is to share their deck with whoever they want to talk to. And I've seen a funny incident where a founder actually mentioned their 5-year revenue projection adding up to say $10 or $12 million in the first deck that they shared. And I'm like, how much revenue do you have right now? And they're like, no, we are pre-revenue. We don't even have the product yet. I'm like, why do you have revenue numbers in the deck? They're like, yeah, but if we raise the funds, then we would get to that revenue number in the next 5 years. I'm like, nobody cares. Just drop those slides. You just need to have 3 slides, 4 in fact. 1 slide which talks about the quantification of the problem and a big number. Then the next slide talks about the potential solution you have come up with and the traction that talks about, hey, this is the big number, which shows how we move the success metric. And third is how big this can become, the market size, top down, TAM, SAM, SOM, like whatever number you want to use. And the last one is the team slide. That's it. You just need 4 slides. And there are different ways you can structure the deck. And let me show you how. So as I mentioned, sending the deck out as part of the introduction is not supposed to be a movie. It's supposed to be a trailer instead. So keep it as short as possible so that investors can see that on their phones while they're getting on an Uber or they're trying to order food from Zomato, and they can simply decide whether to take a call with you or not. So your goal should be just to get to the next step. The goal of this introduction or the first email is not really to get funded. You're not getting funded by that one deck that you sent out. It doesn't work like that. You at least need to have 5 to 10 touch points with any single investor, regardless of the stage or size of the type of investor, to get the first commit. But the goal is to just get that first call. And the way you structure it is basically divide your decks into 3 different types. One is the email or WhatsApp deck. Now that could include like a small 2 or 3 line blurb and a 1-pager with the key ideas, or it can be like a formal PDF. And please don't share links or PPTs. I mean, in many of the phones, they don't open properly, so you need to send PDF files. So that's like the first deck you sent out. That is something which has all the big numbers, the meat of your business. That's like the trailer. You get the meeting, and the deck that you run through in that actual meeting, when trying to convince the investor, is the presentation deck. It is a slightly larger version of the email and WhatsApp deck that you send out. And this has more of the how of your business, like how do you actually do it? Why does this work? Versus the email deck is more like the what of it. And you need to have a shorter deck in terms of the main presentation, and then you need to have a larger appendix where you have multiple different slides and topics that could potentially come up when investors are thinking the problem and the solution and the product through their head. So what I did when I was fundraising was something interesting that you could use. So I used to pitch and collect all the questions that investors used to ask me. And I put them in this huge table. And I ranked them based on the frequency of the questions getting asked. And then at the end of each day, I used to collect those questions and make a slide answering that specific question. For example, in my previous startup, many of them asked, like, how are you going to build this out? Now, how are you going to build the team? What are the technologies needed and so on? So I made like 3 slides just talking about the tech infrastructure. Versus in my current project Introbot, many people talked about our distribution strategy. And we have a unique distribution strategy because we are community first. We want to empower communities at the fundamental level. So what we do at Introbot is get communities onto our Introbot network and try to help them and not do like a massive public launch. So here, many people wanted to talk about that, and we added a slide for that. So these things really help, and you need to learn on the fly as you're pitching and as you're going through the fundraising journey. So your deck is a dynamic something. No, it doesn't work like that. You need constantly your deck. So that really helps in understanding the content that you put outside. And it also shows how much time an investor is spending on which typical slide. So what I've seen in my experience is that if you have a good team, which is awesome because trust your team and they're trying to think through like, hey, should I take this call or not? And they're like, fine, I mean, these are smart folks. The idea looks interesting. Let's just go ahead and take the call. And typically your deck needs to fit your business and your idea. There is no one size fit all. And also in terms of the length of each slide depends on how you have structured it. So there are typically 4 different ways I've seen decks organized. Either you have
Utkarsh, we're unable to hear you. Could you just take a pause and check your connectivity?
Is it okay now?
Yes, better. Go on.
Could you just repeat the last few points you were making, please?
Yeah, sure, Hema. So I was telling about deck structure. So in deck structure, you need to figure out how you want to typically structure the content in your deck. So for every startup, it will be different. There is no one size fit all. And there are like so many templates out there which typically talk about the team first, then the problem, then solution, the traction, and so on. That's one way to do it. But I've realized that there is no one way to do it. You need to understand sorry, something came over my screen. I think Ashima, is that you? Thanks.
Is it okay now?
Yeah, this is better. Thanks. Yeah, so it really needs to fit the problem, and as founders, you need to figure out what's the crux of what you're building. So for me, I've realized that talking about the market first really helps because we are in the space where there's a lot of competition, and we need to introduce the market first to the investors and tell about the gap that exists in the market, and then introduce the problem, and then the product and so on. However, in terms of, so I have lots of friends from Stanford, probably 300 or so in the Stanford entrepreneurship ecosystem. And there are a lot of different biotech companies and deep tech companies that come out. And for them, I typically recommend that they lead with the team first, because unless you are a PhD or a master's in that specific field, your biotech startup probably will not have any legs. So it really, really depends. For other brands, and I've seen this happen with lots of fashion and D2C labels, they drive with the story. Like for example, Nykaa, right? I mean, it's such an amazing story of Falguni ma'am. I mean, she literally came from banking background and then suddenly went into beauty cosmetics and now into D2C and retail. That's like amazing, so inspiring. So I think for her, putting the story out first makes a lot of difference. So again, you need to see that for yourself, whatever works. So get a mentor, actually. What really made a difference in my journey was to get senior mentors who were entrepreneurs in the past. They have built, sold, scaled companies, and they could actually take a bird's eye look at how you're doing stuff and give you feedback. Because what happens is that when we are actually doing things, we don't know how good or bad they are. So that's the fundamental problem. We just don't know what we don't know. So somebody else needs to be out there providing the third perspective, third point of view. And whatever you do, the fundamental takeaway from this one slide is the last point: numbers. So I have a senior founder who told me, his name is Ajay Yadav. He built this platform called Rumi. And he mentioned that use numbers in the deck. If you don't have numbers, it doesn't matter what you're talking. You can say that, hey, I'm building XYZ and tons of people are interested in my new app. But unless you quantify that with actual numbers, nobody will believe you. So throw in as many numbers as possible. And once I heard the strategy and I've been throwing numbers in, numbers about everything, market size, the problem, it could be the amount of time spent in the current method versus what we are proposing. It could be the number of users, the traction, the retention numbers, engagement numbers, DAO, whatever that is. Throw numbers in and keep the text short. I think that's a single most important thing when either writing the deck or when pitching. So moving on, this is the last point. So we are getting close to the end of the talk, but I want to highlight a few things in this section. So don't ask for $1 million at once. I have seen tons of peer founders do this, and I have been a mentor at multiple universities and startup hubs. And I personally mentor like 4 or 5 startups right now. 2 of them YC startups, 1 Techstars, 1 StartX. And so many of them are going out there and asking like, hey, I want to raise $500,000. I want to raise $1.5 million. And for a serial entrepreneur, this makes sense. I mean, they have done it in the past. They know the investors. They can go ahead and raise $10 million on a piece of paper napkin. But for majority of the founders, if you say something over $500,000 without a impressive background, and that's basically the 99% of people, including me, like we don't have the expertise in the past to just go out and raise tens of millions of dollars. So don't do that. What you should do instead is start small and dynamically increase the round size as you go ahead. So what you need to do is basically say, hey, I'm raising $200,000. Get the commits first, and then you start increasing the amount. So this process is what I call a round robin. So suppose you have listed out 200 investors in your pipeline, and then you start sending out emails and intros in batches of 5. And the reason I mentioned 5 is because you need to test your fundraising strategy. So if you get no's from all 5, that means something is not working. So you need to change something, redo the whole thing, and then again approach the next 5 and so on. And when you do that, you should start with the non-dream investors. Like don't write to the top ones. Don't write to Tiger Global, Sequoia, whatever that name is for you. You should start out with people who you know have funded startups like you. They don't have a very high bar. So you start with them, and then you start approaching the next 5 and the next 5 and next 10 and so on. So when you're doing this round robin approach, you try to raise the first $100,000. And that is the hardest thing to do for any startup, especially if they have not raised funds before. Talk to investors, get the commits, get to the first $100,000. And once you have that build up going, then you accelerate your fundraising in such a way that you can actually talk to other investors who are your dream investors, and then quickly fill up your pipeline and your fundraising goal. Once you hit that $1 million mark, that's when you can go up and say, hey, I'm raising 4 million, 5 million, whatever. And after that, it becomes super easy. So raising the first 100,000 is difficult. After that, it's relatively easy. That's what I've found, because that's when FOMO starts happening. And FOMO drives the investment industry. It could be stock markets, secondaries, angel investments, VC funds, doesn't matter. There are so less amount of good companies and startups out there, and so much capital going along in the market. And now with hedge funds and private equity coming in, I mean, there are trillions of dollars of funding out there. So funding is not the issue. It's the pipeline that's not fair and right. And I mean, that's the problem. So once FOMO starts happening around a certain deal, everybody wants to get into that. And maybe you know, maybe you don't, but all of these investors are connected to each other anyway, and there are multiple channels where somebody from Lightspeed is sharing a deal with everybody in the group, and that actually happens. And they do it to cross-reference whether a founder is pitching to multiple startups at once or not. So you need to build the FOMO right there. Yeah, any questions? I thought I heard some mics on. We can take the questions at the end. We are almost ending.
Sure.
Yeah, so what you do is you do the round robin process, you talk to the first 5 investors, and then you talk to the next 5 and so on. And while you do that, the most important thing you need to do is get soft commits. That's the single most important advice that I got from the founder of Techstars. You do whatever you need to do in order to get the commits. And what happens is typically they are conditional commits. So it's not that for the investor tells you like, hey, fine, I mean, I'm ready to put $500,000 in the first meeting. No, that doesn't happen. After your second or third meeting, when they start thinking like, hey, I trust the team, that's an interesting idea, market is big, it's growing, I'm interested in this deal. Then they would typically ask you like, how fast can you grow? Like, can you get to 3x in the next 1 year? Or can you move to Bangalore from, say, Bhubaneswar, where you're living? So what you need to do is you need to give them an agreement or an email to seal the deal, saying that, hey, if you choose to invest in us today and give a soft commit, then before the deal goes through, I will be ready to accept that set of condition. And then you actually get the soft commit and you start filling up your bucket. And the more soft commits you have, the faster your bucket will get filled up and the more FOMO you will build. And at the end of the whole thing, you might even not need to fulfill those agreement pointers that you made with the first investor, because those are where all soft commits. And most of the successful startups in the US raise this way. They run a round robin process, get the soft commits, get to a close very, very quickly. So most of the fundraising processes need to finish in a month. Like if it's taking longer than that, that means there's something wrong in the process or your product or the business or the idea. And the limit is typically 50 investors. Like if you don't get a yes with the first 50 investors you're talking to, that means you need to fundamentally go back to the drawing board, figure out what's wrong, and get business readiness built in and get investment readiness built in. Otherwise, there is no point wasting more time going beyond 50. Below 50, sometimes, yeah, I mean, people don't like the idea, the team, the product, whatever. Like this is not IITJ, this is not CAT. I mean, people skip deals all the time, regardless of how good they are. But if you don't get a yes with the first 50, go back to the drawing board. So there is a certain way you need to do this process and do it efficiently and fast. Happy to talk to founders who want to discuss more in depth on this topic. I've mentored quite a few startups who have done fundraising, learned so much from my own process as well. And I mean, there are certain ways you can optimize for a higher round, check size, valuation, and so on. So this kind of covers most of the topics on fundraising. And I think if you do all of these right, then you get funded, assuming you have the right set of metrics and the right idea and the right team to execute it. Congrats on closing the round. You have achieved the summit of fundraising. For most of the startups, this is a major milestone, especially the pre-seed funding, because less than 1% of startups out there in the global startup ecosystem get funded. So that's a major achievement. You may want to pivot your idea later on. You may build a new product. You may hire a new team. All of that is possible after the fundraise. So that's super important and critical. So great, you get to the summit, you're having fun, but there are a few things that you need to take care of. And let me close the talk by going over those few action items. So the ABCs of fundraising. you need to make sure your company is set up. You need to think through the board seat. You need to think through the vesting schedule. So vesting schedule is basically the period of time after which founders get to access their own stocks. If they leave before the vesting period gets over, they don't have access to the stocks they were entitled to. So make sure the vesting schedule as well as the cliff, the dates are all set in the actual agreements in a proper way. So agreements are typically called SHA in India, and then in US we have something called SAFE, which is a great mechanism for angels to come in early without a lot of paperwork. And in India we are seeing some versions of SAFE as well, called CCPs, CCPAs, OCRPS, and the different terms that different law firms are using. So you need to make sure that is happening properly. You need to make sure liquidity preference is right. What that means is that if your company IPOs or needs to be liquidated in some way, what is the order of exit that you would get if you have a certain set of investors. Due diligence takes a long time. DFAN is obviously one of the best angel networks out there. I've been working with Harry. I've known Harry for a while. They do a great job in due diligence and the speed of investment, but there are other networks out there which take their own sweet time, and that is super prohibitive to startups. So as founders, if you're raising from the angel networks or larger funds, you need to make sure that you understand that there is going to be a time period of 1 to 3 months before the money actually hits your account. Last but not the least, you need to make sure you have the press and PR content right, because that's your moment of glory. People will know that you have achieved the summit, and be ready to handle the fame that happens after your startup gets published in Your Story, Inc. 42, Scoop Whoop, and so on. I mean, the next 2 days, either your servers crash or your WhatsApp crashes, and both has happened previously to me. So, and I mean, I know how that works. So make sure that you're ready for that. And lastly, and this is the major point, the key takeaway from the entire session. Get ready for your next round of fundraising. Use this PR to connect with investors and make sure they know what you're building, and keep sending them updates, and raise the next round without going through this entire process. Because once you have investors on your WhatsApp, on your email, and they know what you're building and you're doing a good job, you have the right metrics, raising the next round would be super easy, because you're only focusing on growth at that point. You have the product ready from the initial fundraise, and you just hit on the accelerator. So ABC of fundraise means always be capitalizing, always be raising, always be in good books of investors, be fair, be transparent. Things always go downhill, and they understand that. So do share that with them. Good investors have been. So good investors are also great partners and stakeholders, and so have been mine. So thank you everybody for joining the session. Happy to address all your questions now. And also thanks to my investors and stakeholders who have said a yes, and also to the people who have said a no, because through them I've learned a lot and improved as a founder. And lastly, scan this QR code to join Introbot. You would get connected to various startup founders, the top investors in India and US. And this is a great tool to meet new people as well. I mean, much better than LinkedIn and all. And I realized that QR code is the best way to kind of share the link. So with that, thank you everybody. Ashima, Hari, Hema, on to you.
Thank you so much, Utkarsh. You've beautifully covered around the entire fundraising journey for a startup founder. Very insightful. Thank you for that. So time for questions. You can put it on the chat.
Maybe we start addressing the ones that have already been posted.
Yeah, the very first question is from Manish Shahi. How Porthole Model helps while building an MVP?
Yeah, so Porthole Model, typically, this is something I came up with. So you wouldn't find definition on Google, but what that means is you try to estimate the size of the pothole, assuming pothole is the problem. So you understand the depth and the width of that pothole. So assume that you're going on a road and it's super misty and filled with fog, like Delhi in winters, and you're trying to find potholes. Like you're trying to understand the market needs within a large market segment. So you run user interviews with specific metrics in mind as to prove or disprove what are the potholes, and are the potholes big enough for you to come up with a solution. So one metric could be identifying the friction in terms of time, money, or inefficiency. I mean, typically all startups that you know of are either saving time for somebody or saving money or generating revenue, which is making money, or they're just fun to use, which is most of the social media apps. Or the fourth category is just making people's lives more efficient. So once you have those parameters set out, you need to figure out if your product is built per se, which angle of the solution will it hit? And based on that, you need to figure out how big is that pothole. And once you have like a number to it, you have to talk to multiple people to understand, hey, like this pothole is being faced by multiple people. It's just not like one or two people. And you need to talk to users for that. You need to have access to that user base. Like some founders tell us that, hey, we are building a music app, but we don't have access to music enthusiasts. I'm like, yeah, but how would you sell if you don't talk to users? You need to sell first before you actually start building the product. So that's the pothole theory. And I can actually jump through the chat, Sashima, and kind of see which questions make sense for me to address.
Okay. Another question I see, is it true that there is no way a pre-revenue startup can ever raise funds? By Shrisha.
No, pre-revenue startups always, I mean, they raise funds. So that's what I'm saying. So revenue is a solution traction. Number of users is a solution traction. So typically in the pre-seed stage, when you're talking to angels, micro VCs, and early stage funds, they just want to know that you have done enough market research and proven that the problem exists out there. So even if you don't have the product, even if you don't have the revenue, if you can show tangibly with metrics and numbers that the problem exists out there, then you'll be able to raise funds. And I've seen many founders I know who have raised without a revenue or without even a product. And experienced founders actually follow this strategy. They sell first, sell the vision. Then using that number, they raise funding. Using the funding, then they acquire the team and then they build the product, not the other way around. Typically, first-time founders try to get the team built first, either through friends or family or somebody from their previous companies. Then try to get the traction on the product, then try to raise funds, and then try to scale. So there are different strategies.
Thanks. Any other question?
Hi, Utkarsh. Can I ask you one question regarding one of my startups?
Yeah,
this
sure.
Is Saurabh.
Yeah, sure.
See, like we are an e-commerce startup wherein we are aggregating the online market on one platform, and our tech platform is ready. And we have done the, MVP testing with close to 250 sellers of Delhi NCR. Now, my question to you is this. We know that the problem exists because, the entire NCR market is scattered over maybe 80 square kilometers. And there is a lot of friction of one person going from one place to another. And these are very popular market. People love to, buy those stuff from their side. So is it a right time to, seek funding, or should we onboard, let's say, one or two market and then have some traction and then go for a round of funding? What do you suggest?
Yeah, that's a great question. And I have asked this question to myself as well. The way you think about funding and when you should start fundraising is walking backwards. So basically, you set out the business milestones first. For example, we know that in Introbot, we have to get to 10,000 early stage businesses by the mid of next year. That is the next milestone for us. And using that, we are going to solve a certain mission or vision that we have.
Right.
Once we have that metric, then we figure out like, hey, what do we need to get there? Do we need extra capital? Do we need a team? Do we need tech support? What is that? Then you break it down into the amount of money that you require. If you think that you already have that money from revenue, then fine, you don't need to raise. If you don't, then you probably go out and raise. So it's not so much as ठीक है raise कर लेते हैं. It's more like, where do you want to get to? And for many of the startups which are not VC fundable, I mean, they don't have the hockey stick growth, or they just don't fit in the definition of a tech startup. For them, fundraising may not be the best way to get capital anyway. I mean, they can get from customers, they can get a loan, or there are so many other sources. So you need to figure out the business metric first and then backwards.
And one last question on the same thing. We are running short of a capital, but you know, being a founder holding 100% equity among me and my fellow co-founder, what is the ideal amount of equity dilution? Let's say if you wanted to raise, you know, maybe 1 year of a funding.
Again, it has to, so you need to figure out what is the end goal. Do you want to get acquired or do you want to IPO? And then how much holding do you want at that time in terms of founders? Typically for most startups, if they're IPOing or they're getting exited after Series D or E, they hold single digit shareholding anyway in the company.
I agree, like Oyos and the other Paytm founders.
Yeah, I mean, Zuckerberg did a great thing. Like, he skipped an entire round and they actually made a lot of money. So that is the reason he holds a lot of power.
Influence.
Yeah, and influence. Also because of the class A and C structure, like, or Google also follows that. So based on that, you need to walk backwards and think, what kind of shareholding do you need at the end of this whole thing? And then you negotiate with investors per round. Having said that,
Utkarsh, there is one minor aspect into this. I'm not much worried whether my shareholding remain in a single digit post IPO. Like if you see the example of Oyo, wherein he has raised multiple rounds of money, and thereafter even he know that if he go and enter into a China and Hong Kong market, it will be a disaster for him. But just because he has lost his voting shares and the investor presence that you need to go into that market, and he has sustained, I mean, he has burned his money. So how to avoid those losing control over decision-making aspects?
Some senior founder told me this, that if you have to actually fight on boards in a board meeting, then you've already lost control. So control for a founder does not come from, say, the capital or from the exact shareholding or in the board seat. It comes from the influence and the vision. So I've seen that if most of the companies are being driven in the right order, investors are okay giving full control to these founders. The problem happens when founders are not doing the right job, and that's when good governance and other things come in and investors need to take control. But fundamentally, it should not be the question of the shareholding unless something gets really screwed up. And also, I just wanted to cover in my last point is that in each round of fundraising, a typical startup ends up diluting 15 to 20% per round. It could go as high as 25-30% as well. But now that it's a very founder-friendly market, I've seen it is coming down even lower. Like in my case, we have diluted less than 15% per round because we had more leverage, because we spent a lot of time working on the product and having more traction. So it also depends on leverage and how much traction you have.
Thanks, Utkarsh. I mean, you have, solved most of my problems. And it's really a nice way of looking at the same issues with what you have conveyed.
Thanks so much. I mean, please do ping me on LinkedIn. Then happy to address any further questions.
Yeah, sure. Thanks.
Utkarsh, this is Neeraj. So I just need a couple of guidance from you. I just want to start something. Like my daughter has just come up with an idea, so I'm just trying to just come up with something. And we have created some prototype, etc. It was an initiative taken by Atal Tinkerpreneur, and wherein she learned the art of creating some kind of ideas and coming up with the business model. So that idea got shortlisted, and she ranked #1 in ATL Tinkerpreneur, I would say, judgment. So now I just want to help her out in terms of turning her dream into reality, and it is on women employability and empowerment. And the only thing is, we created prototype, whatever they told, like my daughter created everything. Now we want that, how should we just proceed further? Proceeding in terms of, since pitching, etc., they taught, everything was done. So what should be our next step? The next step should be like, we should just invest something and then create some basic stuff before we go for funding, or should we go for just go and pitch the same thing what we feel that is the best idea from our side, and then look for funding first and then start building? So what's your opinion on this?
Yeah, I mean, first of all, congratulations, Neeraj. I mean, this is a great progress and love the news. I think what you should do is map out the ideal business journey for the next 2 years at least. Like, this is the milestone you want to achieve. Do you want it to be funded per se and make it VC fundable, or do you want to retain control and kind of power more on the revenue side of things? I mean, it totally depends on the idea itself. Once you understand what's the business goal, then you figure out, in order to get that, like, do you want to raise funds or not? And if you want to raise funds, then there are different ways, as I mentioned, to reach out to investors for the specific type of market, the product. And different analysts, different associates and partners look at different fields, and happy to connect you with certain investors after the talk. And also, like, using Introbot, you can actually ping and find such investors in the network, and you can just talk to them. Like, you don't need to actually start fundraising. You can just ping 2 or 3 people and say, like, hey, this is what we have built. This is the traction we have got so far. This is the effort and time and money we have put in. Would you be able to look at the deck or the idea and tell us whether we are fundable or not? Whether, if we pitch, would you fund us or not? Are we ready? If you see a pattern of, say, like 5 people saying no, that means you still need to do some work. If you see, like, hey, this is great, let me introduce you to my partner, why don't you share a deck? If you get positive signals, then that's when you know that, hey, this idea has legs and you need to start fundraising. And typically we need to have a team. Like, single founders or family and friends backed founders have hard time because the way investors think is that, hey, like, this person has not been able to convince somebody else to join the team. They have not de-risked from a team point of view. So at least 2 or 3 core members in the team is crucial before you start reaching out to investors. And on the other hand, I personally feel, now that I've gone through the different phases, raising capital later on makes a lot of sense for a lot of startups, because they don't have to really worry about investor relations, paperwork, company structure, due diligence, press and media. I mean, they just focus on building a good business. And I have few founders who run like that, and they're super efficient and very successful. There are different models.
And how about, I think, thank you for all this guidance. So how about the technology or solution? Because what we feel like, based on our own understanding and knowledge, we would only look at those technical glitches or technical expert stuff, that these things should be used, but could be possible that may not be the right decision at this point of time. So I just want my daughter should not make any such kind of technical mistake at this point of time, so that in future there should not be any need of reinvesting on technical infrastructure and then rebuild everything to take this venture forward. So what should we do in terms of getting those technical nitty-gritty validated before we proceed further with the building the product?
Right, that's a great question. Again, I think my answer would help a lot of people, and I've done the same mistake. So let me throw some light. So there are 2 parts to this answer. One is like, don't focus too much on the technical side of things. Like, focus on getting the sales first, getting more users, and making sure that somebody is willing to buy that even before you build. So the way to do it is just put an ad on Facebook, Instagram, like saying, hey, like, sign up for this thing, and I'm building a very new photo sharing app. Sign up for this. Just run the ad. If you don't get at least, say, 500 signups after you run the ad for like $100 or stuff, that means people are not interested. They're not clicking. So then you don't even worry about the tech. You need to focus on the idea, like shaping up the idea in a way that will actually help some people. So keep on iterating on the idea itself and doing user interviews. But assuming that you have the list generated, like there are 1,000 people on your wait list and they're saying like, hey, we want the product. Like, where is the product? When is it launching? We are super interested. We connect with the idea, the vision, whatever. We are facing this on a day-to-day basis. User coming to you, you will feel that, like, people come to you. Like, for me, on a typical day, I'm talking like 5 to 6 investors or founder on a day-to-day basis, and they come to me like, we want intros to XYZ. Can you connect me to, say, somebody at Reliance? Can you connect with somebody at Sequoia, and so on? So we know this problem exists even without building the tech. That's when you go ahead and build the tech, and either you hire a co-founder to join you, like a technical CTO, or you raise funds and then you hire somebody who can build it for you, or you get a freelancer from multiple sites out there just to test out the MVP. Having said that, my second part of this answer is, don't worry about the tech scaling. Founders typically, when they're building the first time, they want to make it so heavy and complete that they end up adding for all the different use cases and trying to make the solution perfect. That doesn't help, because the solution is anyway going to get thrown out after 3 months if you run the business fast enough. So just get the bare minimum tech stack out there that solves the first set of use cases. That's it. Don't worry about other use cases. Because after 3 months, if you're running the business right, you will realize most of the code that you've written for the first set of problems do not work anyway. And with every stage, you need to upgrade your tech platform. And the way I tell my team is, think about the next exponent. If you have 1 user, don't think about 1 million users. Just build for 10 users. Once you have 1,000 users, then you build for 100,000 or say 10,000. The tech should only support 10,000. After that, if say 50,000 users come in with a great PR or great Times of India article, fine, let it break. We will handle that at that point of time. But typically that doesn't happen unless you're the next Prisma or TikTok. I mean, those are unique stories, but typically getting to the next milestone is very hard for startups. So don't worry about tech, worry about the sales and getting traction first. Once you have traction, funding will follow. You will be able to build the tech in the right way. And if CTO who understands the problem and believes in the idea, they will rewrite the complete tech stack anyway. It probably won't be somebody who is thinking of the idea.
And is it required at this stage just to have some kind of mentoring or some guidance just to get the idea validated again before I proceed further, or should I just go with my gut feeling and just proceed with my further actions?
Yeah, so the way to think about this is, start with the gut feeling. That becomes the hunch. Like, you have the hunch. You write down the hunches, like, okay, I believe that metaverse is going to be the next social media, or people are not commuting, they are going to more Airbnbs. So maybe I can create an ad platform for Airbnb homes. That's the hunch. You write down a couple of hunches, then you do user testing and talking to users and trying to validate that based on what hunch is right or not. Based on that, then you think the next steps, essentially. So it's typically, it's not the idea to the product. It's something in between. Does it answer your question, Neeraj? Or?
Yeah, got it. Got the sense. Thank you. Thanks, Utkarsh. It was really nice.
Yeah, please reach out to me over LinkedIn. Happy to address one-on-one.
Sure, definitely. Thank you.
Hey, Utkarsh. I've got a question. I have a fintech startup, and we are in a crowded space. I'd say relatively crowded space. Our proposition is to improve on the existing value proposition. Like, basically, we are trying to make it more efficient and more personalized. So my question is regarding how do we handle the keywords? Because if we are tackling the same proposition, but we are improving upon that proposition using the same keyword for somebody who has not looked into our solution yet, might mean the same thing as an existing solution. Only when they look at the solution do they realize that, okay, this is actually better than the existing solutions. So any tips or ideas around how to get around this?
So let me try to rephrase that question. So you're saying that you have built a better solution, but then most people don't know that it's a better solution, and there is no way to attract them. Once they get attracted and come to the solution, that's when they realize. So you are facing like a distribution challenge here. Is that your question?
Yeah, and also finding the right, I would say the right keywords. So we are still iterating. We are still trying to figure out what would rhyme with people. So yeah, we are still in that journey. Just that I thought might as well ask you, since you are also in a crowded space. So I thought might as well ask you if you did face that problem and eventually you figured out that, okay, this is how you should tell your story. These are the keywords that could help.
Yeah. So I think the key way to figure this out is to run A/B testing. You start with a hunch, and most likely that hunch is not right. So you come up with these theses and you A/B test on your marketing content with those theses, and you use different keywords. So for example, Introbot can be a community manager for certain communities. It can be a super connector in the startup ecosystem. It can be a product that makes introductions and makes facilitating introductions in a better way. So these are different variations of the same product and the way we communicate that with users. The challenge here is that we as founders don't know which will work. We have a thesis, but most likely that thesis is not right. So you have to put those out, talk to users, and then figure out which of these sticks, which of these does not. And what you will find that in the early days, most of these will not stick. So you will get a small, thin funnel of users coming in, and then they realize, hey, like we thought the product is something else, but then the product does something totally different. And then you ask them, like, what did you expect? Why did you come to the platform? So you try to understand the intent, and from the intent, you generate the actual keywords. And then you test those keywords with a new set of people. So once you repeat this process 4 or 5 times, you will know the keywords which stick. And this is basically a funnel, right? The funnel starts with a user understanding that they have a problem. Then they search for a solution, which is the discovery phase. Then there is a choice phase where they typically decide, hey, I want to download this particular app. I want to download Calm because I am stressed out. I'm depressed. I want to try out Calm. The next stage is trying that out and deciding whether I like that product or not. And the last stage is retention, whether I want to come back to the product or not. So what you are facing is basically the shrinkage of funnel in the discovery stage. So you need to experiment with multiple sets of marketing material and with different sets of user groups and increase the top of the funnel for your distribution. Once that happens and they can actually use your product, that's when you figure out, do I want to stick with that? Do I want to change the copy or do any other variation to it or not? So it's an iterative journey, but start by increasing the distribution, because most products fail because of distribution, not because of the product itself.
Great, thanks.
Hi, okay, this is Rahul here. This is a follow-up question on what Ajit said.
Mm-hmm.
So you mentioned about this power of iteration, right? And then it's more like a chicken and egg situation, right? So if somebody who's founding up and who does not have an MVP, or who is basically in the B2C space, then what would this iteration mean in a crowded space? So you just go out, do a public surveys, you speak to users, because let's say if you speak to somebody, I don't know, on a train or through some survey monkeys and stuff like that, then how sure you can be about what you sort of tell them and what you basically hear from them? Because if the incremental benefits or the incremental improvements that you're offering are probably small to start with, then how much weight would you put on those kind of surveys? What would you learn from them, unless you have a product itself to sort of show and let the user experience, right? So it's more like a chicken egg situation. So you have to build the product to basically tell your story or show the incremental distribution differentiation, or you just basically are stuck there, right? You see what I'm trying to say?
Yes, totally get it. So let me give an example. Suppose you're trying to build a remote work competitor to Zoom. Essentially, it's a holistic office space where you have multiple options in the same product itself and makes it super efficient for professionals. That's what we're trying to build. Now the question becomes, people already are aware of Zoom. How do you get them to test this? So when I mean surveys and experimentation, it's not on the solution side. I'm talking about experimentation on the problem side of things. So typically there are different kinds of user interviews and tests. One is where you're trying to understand how the product is performing. That's a product user interview. Then there are user interviews around the UX of the product, where you typically watch how they are interacting with it. The intent is clear, but they're not using the product properly. There's a third type of interview, which is the problem first customer interview. In that interview, you typically don't talk to users about a solution. You talk to users about their life and try to understand what they do, what are their patterns. Ask them like, hey, are you facing any problems in getting to a meeting? Or you would put out a survey saying like, on a scale of 0 to 10, how efficient do you find the current Zoom solution to be? Or how efficient do you find booking meetings on Google Calendar to be? And you run it with 100 people. And this is like a generic question, but you need to be more specific. Once they say, yes, I mean, it's difficult. Like most of the people say 8 out of 10. Then you would start seeing the pattern in your Google Forms report. So for example, in Introbot, I ran a survey asking people how many times do you need to connect with people outside your network, basically finding new intros. And for most founders, it was somewhere between 4 to 5 on a weekly basis. So we could figure out, yes, the intent is there. And then it's testing against the intent. So once we collect this list of people who have showed that they have the need and they have the demand, then asking them, hey, can you try out this product that I've built? This could solve your specific problem by 50%. So this is a 10x better solution. So you need to play around the problem part of the survey and also the solution part of the survey. So at this stage, what you need to do is you need to run surveys around the problem side of things. Because what will happen is that, yes, there is a problem. You identified it. You have a good hunch. But a lot of people don't really connect or don't want to solve that problem. Like, fine, you build a better solution than Zoom. It's more efficient. Yes, we agree. But that is not a problem that I want to solve for my own life. So that survey will tell you that. And typically, if it's a well-built survey, then the patterns come out very easily. So even building out those initial surveys and choosing the right user persona that you need to talk to is an art itself. It's not easy. I mean, I have run it multiple times, so I can make those surveys, but I understand that as new entrepreneurs, it's slightly challenging. So you will see like results all over the place, and those surveys don't tell you anything. But if it's a well-crafted survey, then you get a lot of these answers in the very first go.
Thank you.
Any more questions from the group?
Yeah, I see two other questions in the chat. One is, do services companies also get funding? Somebody here by the name Richard is into cleaning services.
So I will tell you the thought process behind funding and why you have funds out there that are willing to fund. So some guys in Silicon Valley figured out that, hey, we can make 40x IRR in the next 10 years if a technology is driven by technology, if a product or solution is driven by tech, because tech can scale much more than adding people. So they came up with these models, and they basically raise money from LPs, which is limited partners who fund these big VC funds, the capital that they invest in startups. And they have a investment period. So they initially deploy capital in the first 2 to 3 years, and then they make sure that founders execute in the next 3 to 5 years. And the last 2 to 3 years in a 7 to 10 year period, they need to return the funds back to their LPs. That's how a VC firm model works. So what happens typically in the startup ecosystem? 98% of the startups die, even the funded startups. So what ends up happening is that a very few minority startups actually become very successful, either the IPO or the exit, and they return most of the fund money. So it's a power law at its peak. And the reason being that startups fundamentally do not have a business model in place. That is the reason they're called startups. And that is fundamentally why investors need to see a hockey stick growth and a compounding growth. The problem with services startups are that in order to service, you need to add more people. You cannot throw in code or a new distribution plan in order to get the hockey stick growth. So services startups typically have either a linear growth or like a step function growth, which is much slower than something a typical VC would expect back. So they assume when they invest that you would become the next unicorn if things go right, and that single investment will get the entire fund back. Typically, services startups are not able to do that because of the way they're designed. That's fundamentally not designed that way. So yes, you can get funded by angels, by banks, by investors who are willing to, say, get revenues or income sharing. But if it's like a share-based income and we are doing the IRR play and 20xing in the next 5 years, then it becomes a challenge. So I hope I could convey the thought process behind why product-based startups get funded and why service startups do not get funded. That's the logic.
Okay, thanks. Another question: how can we get funding for idea or POC stage startup in order to build the product having high potential and projection based on the market demand?
So there are two key things here. One is either you have a solid problem statement and you just need the connections from investors in order to get the funding. If that is the case, then feel free to use Introbot or any of the channels that I mentioned in order to connect and find the investors. And you already know that you are investment ready. You're ready to take the funds. You're ready to deploy the capital in the right way. And that's a connection problem, which can be solved through using different channels. But if it's not a connection problem, it's more of a business readiness problem, then you need to work on the idea itself. So as I mentioned before, so if you're still in the idea stage and you need funding to build the product, most investors do not require a product. Most investors require a traction. So many of the founders try to prove the traction by building the product, but you can actually build the traction by convincing investors that this problem exists and at a scale. So for that, you don't actually need a product. You can run surveys, you can figure out other ways to generate traction, and also you can use like no-code tools to like build the initial version of the product, or you can use designing tools in order to make the MVP and so on. And those are relatively cheaper. Yeah, so Pooja, so that's not true. In India, that is true so far, because in order to prove the traction means prove that your business will succeed, right? So in order to prove, most of the people had to build the product. But for most of the good angels, you don't really need to have the product built. If you can get a good deck and you can prove that if you were to solve this problem by taking in their money, then it's a good enough proof that you will be able to raise the initial 100,000 to 500,000. And on top of that, you have many accelerators. Like we are part of Antler. So Antler is a great accelerator, one of the top ones in the world. You have Techstars, YC, you have university-based accelerators like CI of IMB has an accelerator. So there are different ways you can raise small grants. And also there are multiple VC firms that are now focusing on students and idea stage startups like Grad Capital. And there are new programs coming out as well, where you can like just raise a grant of like 15, 20, 30 lakhs to build the initial version of the product. But typically I can ensure you that if you have got the problem and the traction right, you don't really need the product to raise funds. It's a mixture of other things. At one point, I had a great product. We had written 200,000 lines of code over a span of 1.5 years, spent almost $50,000, could not raise funds because product was not the key driving factor. It was something else, and we missed that out. Now that we have been raising funds frequently, we realize product is not the key. It's something else, and something else is the traction. So I hope I could address, Pooja. I'm happy to answer one-on-one any further doubts you might have.
So any other question by anybody? Okay, I think we are good to close the call. So on the behalf of DFAN and Mighty Startup Hub, I would like to thank all of you, especially Utkarsh. Great insights, and so happy that you answered all the questions. Also, I would like to announce that another session is being organized by DFAN and Mighty on 26th of November. Details will be mailed to everybody. Looking forward to your presence in our upcoming webinars too. Thank you so much.
Thank you, Utkarsh.
Thanks, everyone. This was great. Love chatting with you. Bye.
Thanks, Utkarsh. Awesome. Take care.
Yeah, hope you all liked it.
Thank you.
Thanks.
Please share your feedback on my LinkedIn. Would really appreciate it.
Sure. We'll do that.
Sure. Absolutely.